Hello. Let me pull my comments up here so that I have them, just in case I have anyone that wants to interact with me. I don't have those up here just yet. And then, there we go. Then I'm going to go ahead and get started. Hey everyone, I'm Debbie Hatch. I am here tonight for Friday Night Live. Hey Stacy. And tonight's topic was actually suggested by Corey Brockman. So thanks for that, Corey. I want to talk about why I continually say TSP Roth is not a Roth IRA. And I'll tell you, this comes up in every single class as well. So hopefully this is going to be really good information for you. I don't know why I didn't think about talking about it myself, but Corey suggested it, and I think it's just a wonderful idea. So I'm going to just jump right into this. I try to keep my Friday Night Lives short. 20 minutes is what I'm shooting for. I go over that quite a bit, but I'm going to try for 20 minutes. Okay, so you can see my slides up here where if you are under FERS, the Federal Employees Retirement System, and this is the system that's been in place from 1983 through today. We also have CSRS, we also have CSRS offset, and they can participate in TSP, which is the topic of the night, but the FERS people is critically important. Not only can they participate in TSP, but they absolutely need to be if they plan to have any money in retirement. We call this FERS retirement a 3-tier system because you get 3 different payments at 3 different times from 3 different places, and those are showing on the slide here. First, we get our retirement, which we may call our annuity, our pension, our FERS, our retirement. It doesn't matter what you want to call it. That's a once-a-month payment that you get from the Office of Personnel Management for having been a federal civilian. And the money that we have for that retirement is kept in something that's called the Civil Service Retirement and Disability Fund. So that's the top box here. We're not going to talk about that tonight. In addition, we do have access to Social Security retirement under FERS because we're paying in. Our CSRS offset partners are paying into Social Security as well, but our CSRS employees are not. Doesn't mean they can't get it, but they're not getting it for their federal work. I'm not going to talk about Social Security tonight. I am going to talk about TSP, and the reason that I showed you all of the boxes as we talk about this is that the FERS retirement benefit, face value, is about half of what the CSRS retirement benefit is. There's a 3-line formula that we use for them, but the bottom line of that formula is 2% of the individual's high 3 average salary, whereas a lot of people under FERS get only 1% of their high 3 average salary. Numerous exceptions to that, and again, we're not going to get into it, but on the foundational level, CSRS was about twice what FERS is. When FERS was created and this pension was cut, though, they gave us access to Social Security for the first time, and that is the same time that TSP was created. So it functions similarly to a private sector 401k, where federal employees contribute money, their employer contributes money, and we decide what to invest in, we decide what to do with that account later on. There's a maximum amount that we can contribute to our TSP, and this changes normally every couple of years. For 2021, we can contribute up to $19,500 under something that's called regular contribution, and that just means anybody can do it. It doesn't matter how old they are. It doesn't matter if they came to work yesterday or they're going to retire tomorrow. If we want to and we can afford to, we can all put $19,500 into our thrift. Additionally, for 2021, if we're going to turn 50 or older, we could put another $6,500 in there under something called catch-up. So the $19,500 is for everybody. The additional catch-up is only for those people who are maxing it out. They're already putting in their $19,500 and they're going to turn 50 or older. They decide that they want to put some extra money into their TSP as well. TSP has been around since the creation of FERS. It actually opened its doors to investors for the first time back in April of 1987. We've gone through a lot of changes since then. The Roth TSP, which is what I ultimately want to focus on tonight, didn't come in until 2012. And we can say that, like a Roth IRA, the Roth TSP allows us to pay our taxes up front. And like a regular IRA, a traditional IRA, traditional TSP allows us to pay our taxes later on. So they are similar, and that's why we've got that title attached to them. They're just not IRAs. And I'm going to show you why I'm saying that as we go through this Friday Night Live. So there are 3 sources of potential money that can go into TSP. For our CSRS, our offset, and our FERS employees alike, we can personally contribute. We can do that $19,500, and if we're 50 or older, we can all do that additional $6,500 too if we want to. This does always have to be done through payroll deduction. Now, I could roll IRAs into my TSP or even 401ks if I work somewhere else. That's allowed, but that's not going to impact these limits because these are limits for new contribution. And frequently people will ask me if this includes any money from the government. It doesn't. The person can put in these amounts themselves. Additionally, if I am under FERS, or something called the Blended Retirement System, BRS, which is for the military, but not CSRS offset, because the pensions have been cut under FERS and BRS, we get money from the government into these retirement savings accounts. We get an amount that equals 1% of our biweekly paycheck. Those are called automatic contributions because we don't have to be putting any of our own money in there to get them, but we do have to stay for at least 3 years in order to be vested in those funds. If we leave within the first 3 years, we get to keep our money. We get to keep the matching contribution. We don't get to keep the 1%. They take that back. Once we've worked for 3 years or longer, now it does belong to us. In addition to my contribution and that automatic 1%, as a FERS or a BRS military member, I'm also entitled to matching contributions. The matching is dollar for dollar on the first 3% that I contribute and 50 cents on the dollar for the 4th and 5th percent that I contribute. Now, I've just said that the most easy to understand way. It's actually a little bit more complicated than that, and sometimes people get confused about it because we're limited to a dollar amount, right? Depending on what my job is and how much money I'm making, $19,500 could be 1% or it could be 100% of my pay. So I can put in $19,500. What I'm putting in there, they look at dollar-wise and compare it back to my paycheck. Now, if that dollar equals 1, 2, or 3% of my biweekly paycheck, I get the full match of 1, 2, or 3%. And regardless, I'm always getting the automatic 1. I'm contributing. They look at what I'm putting in there. They compare that dollar back to my paycheck. If it equals 4 or 5% of that biweekly paycheck, the match for those two is at 0.5. And I'm always getting the automatic 1. So what I'm putting in is 5. I get the automatic 1 and a total match of 4 because the last two were at 0.5. That's 5 from the government. I double my money before I even start investing in anything. This will be for another stream. It's important and I need to spend some time on it. But trust me when I say, if you're a FERS person, the minimum that you should be contributing to your TSP every 2 weeks is 5%. So that you can get that full government match. If you're not putting in at least 5%, you are missing out on free money. The other thing I'll say, more or less in passing, again, I'm not going to get deep into this tonight, is pay attention. Pay attention because the matching happens bi-weekly. So if you are aggressively putting money into your thrift and you hit that limit and it's the 15th of November, you're done. If you're putting in nothing for the rest of November and nothing for December, you're getting no government match either. So do take your time getting the money in there. You should spread it out equally over the number of pay periods that you're going to have in this year. If you're going to have 26, which is pretty normal, then we're talking about putting in $750 out of each of them to get to the cap, but not too soon. And if you're doing the 26,000 because you're 50 or older and there are 26 pay periods, well, then of course you're putting in $1,000 out of each of them to get to that limit by the end of the year, but not too soon. Again, I wanted to mention it because it's really, really important, but I don't plan to get too deep into that tonight. This Roth option has been available since 2012, and it is just that. You decide whether you want to do traditional TSP, where you pay your taxes later, or Roth TSP, where you pay your taxes now, or you can do both of those things. So one reason that somebody might choose to do the Roth is that they feel they're in the most advantageous tax situation right now that they're going to be in. They don't want to wait and pay their taxes later, which is what they would do in a traditional option, because they feel that taxes are going to go up, either across the board or for themselves. It doesn't matter. If taxes go up, of course, I don't want to pay that extra amount. By doing the Roth, I paid what they were today and I'm done. So that's definitely something that I may want to consider. Another thing that a lot of people don't seem to understand is that if I'm willing to pay the taxes now and I do the Roth, then if those earnings are qualified, and I'll define that for you in just a minute, my earnings would be tax-free. I pay the taxes on what I'm putting in now, but I'm investing in something, and hopefully if the market's doing well, I'm making some money for myself. If those earnings are qualified, then I don't have to pay taxes on those earnings, which can make this a really, really beneficial thing for somebody to do. Now, it's not a Roth IRA because Roth IRAs have earning restrictions. Some people make too much money to be able to contribute to a Roth IRA, and the restrictions change every single year. TSP Roth doesn't have an earnings limit. So anybody can do Roth TSP, but only people below the limits can do Roth IRA. And you see the limits right here on this slide. They come directly from the Internal Revenue Service. And I want to explain something because, again, this can be a little bit confusing if you don't know exactly what you're looking at. If I am an individual and I file a single tax return and I make under $125,000, then I'm allowed to contribute to the Roth IRA up to the maximum amount. And the maximum is $6,000 for the year. If I'm over 50, there's an extra $1,000 for a max of $7,000. So below the 125, if I'm a single tax filer, or below 198, if I'm married and we file a joint tax return, we could do the full amount. Between the 125 going up to 140 for that single tax filer, and between the 198 going up to 208 for the married couple filing joint, we can do something, but we're not allowed to do the full $6,000. And if I'm single and I made above the 140, or married, we made above the 208, we can't do a Roth IRA. Like I said, there's no such income restriction with TSP, so anybody can do Roth IRA, or anybody can do Roth TSP. Not anybody can do Roth IRA. Another point that I find that can confuse many of our federal employees is those matching contributions that I mentioned and that automatic contribution from the government that I mentioned. So here I have just drawn a box which represents my TSP account. And you can see the cap on this box, which is my annual limit, the $19,500 plus the additional $6,500 if I'm 50 or older. If I decide tomorrow that I want to participate in the Roth TSP, they're not going to give me a completely different box. I don't get another TSP account. I've already got one. But they're going to push all of my money over to one side and build a wall somewhere in the middle of this box, okay? It didn't change my cap. So whether I'm doing Roth or traditional or both for TSP, the cap is still the 19,500 plus the additional 6,500. But now I've got a wall in the box with the Roth money on one side and the traditional money on the other side. When that wall is built, any money that is in the box at the time stays traditional. It can't flow through that wall. It's steel. It's not permeable. It's got to stay traditional. So on the Roth side, the only thing I'm going to see are my new contributions going forward. That traditional side of the box will be taxed later. That Roth side of the box will be taxed now. If I'm putting money into the box, it doesn't matter where my money goes once it's in there. As long as I contribute to the box, yes, I get the matching contributions. And whether I contribute to the box or not, yes, I get the automatic 1%. But the government's money is always going to be on the traditional side of the wall, even though my money could go 100% on the Roth side of the wall. Like I said, something that comes up in every class and a lot of people are unclear about. I also said that one reason to do a Roth at all, a Roth IRA or a Roth TSP, is that if the earnings are qualified, they're tax-free. So what does that mean? That means that I have had this Roth open for at least 5 years before I pull any of the Roth money, and I don't touch Roth money until I'm 59 and a half or older. When we talk about the 5 years, it is from January 1st of the year that I opened the account. So it's not 5 years for this one and 5 years for this one and 5 years for that contribution. It's 5 years back to January 1st of the year that I opened the account. So it's August now. If I do it tomorrow, come January, I've already got credit for a year. 5 years, I don't touch anything. And I'm 59 and a half or older before I touch these earnings. That's when the earnings are tax-free. So again, depending on what you've got going on, how long you're going to work, how long you are able to let that money sit there, those earnings can be substantial. And not having to pay taxes on them can definitely be a really good idea. And I'm not saying this is for everybody. I'm saying it is something that you definitely need to be aware of so that you can make a good personal choice for yourself. Now, one of the other differences between Roth TSP and a Roth IRA, the Internal Revenue Service has something that's called a required minimum distribution. Required minimum distribution is on traditional IRAs and 401ks, and it's all about taxes. When you are 72, it used to be 70 and a half. That recently changed. So if you're thinking 70 and a half, you weren't wrong, but it's now 72. When you are 72, you have to start taking a distribution from those tax-deferred accounts and start paying your taxes. You don't have to take a distribution from a Roth IRA. You do have to take a distribution from your Roth TSP when you are 72 or older. And again, that's something that a lot of people don't know. I only learned that a short time ago myself, but I want to show it to you in writing. So this comes directly from TSP's website. You can go there, tsp.gov. You can type in required minimum distribution. You can pull it up and you can read it for yourself. But it does say right here, your entire TSP account, both traditional and Roth, are subject to the required minimum distribution. That is important to be aware of. And that means if you don't want to pull the Roth money, you need to move it from your TSP Roth to a Roth IRA shortly before reaching age 72, so that you don't have to take those distributions. Now, you would be allowed to do that regardless of how much money you're making. We call this a backdoor, right? If you are rolling money into that Roth, then it doesn't matter how much you're making, you're allowed to do that. But if you leave it in your TSP, you're going to have to start taking a distribution on that Roth when you're 72. And the way that the Internal Revenue Service figures out what that required minimum distribution is by looking at your account balance effective December 31st, looking at your life expectancy, and then dividing that account balance by your life expectancy. And the answer is your required minimum. You could take out more than that, but you can't take out less than that. And remember that this does apply to your traditional IRAs and 401ks, even outside of the federal government as well. This table came directly from the Internal Revenue Service website. If you want to look at it, go to irs.gov and just type in required minimum distribution or RMD. If you heard something tonight that has piqued your interest and you've decided, yes, the Roth TSP is something that you want to pursue further, you make the change by going into your payroll function. So whatever you are using for payroll, the screenshot that I happen to put up tonight is from the USDA, which is using EPP. But all of our federal agencies have a different payroll function. Whatever yours is, that's where you can go and make the change. It has to be made through payroll, not directly with TSP, because payroll has to know to take the taxes out for that Roth before they put the money into the TSP account for you. Just as I said, and I'm coming up on 24 minutes now, so I'm going to wrap this up. Just as I said, Roth TSP is not a Roth IRA. Traditional TSP is not a traditional IRA either. So a lot of times folks will ask me if they can do both. Can I max out my TSP and also put some money into a tax-deferred IRA? And the answer is maybe. It depends on how much money you're making, because traditional IRAs have earnings limits too. The numbers are different than the Roth IRA, but the fact is still the same. You make below a certain amount, yes, you can do it. Between a set of numbers, and they're right here on the slide, I don't need to read them to you. You can do something, but you can't max it out. And then above these earnings restrictions, you're not allowed to put more tax-deferred money into an IRA because you have an employer-sponsored retirement. We happen to call it TSP. One reason that I wanted to also point out that it's not a traditional IRA is that if you pull a traditional IRA and you're under 59 and a half at the time, not only do you pay regular income taxes, but also a 10% penalty tax for early distribution. A lot of federal employees believe that 10% penalty tax applies to our thrift. It doesn't. We're just using the wrong words. It applies to an IRA. TSP is not an IRA. So as long as you are 55 or older when you retire, you pay regular income tax, no 10% penalty. And if you are a special provision employee, which includes federal law enforcement officers, firefighters, air traffic controllers, customs and border protection officers, if you're under special provisions, you can retire at any age with 25 years or at 50 with 20 years of special time. As long as you are 50 or older and retire under special provisions, you are exempt from that 10% penalty. For everyone else, it's 55 or older, but it isn't 59 and a half. People are saying that because they're confusing this with an IRA. Okay, I have, once again, I don't know if I can ever do a 20-minute one. I hope to, but hopefully you find it helpful and useful. And even if you have to stay for an extra 5 or 6 minutes, I hope that it was worth your time. If you have any questions, drop them in the comments. I'm happy to provide answers to you at any time. If you have suggestions like Corey did for things that I can talk about on future streams, let me know. Drop that in there. Send me a private message. Contact me some way, somehow. I'm getting off here. I hope that you have a fantastic weekend. Thank you, Stacy. Thank you so much. Brent, I know you were surprised by a little bit of that, so we'll have further conversations about it. Everyone enjoy your weekend. Take care. Let me know how I can help you.